We've put the election noise behind us and can breathe a collective sigh of relief that our GNU is in place. However, the savings industry faces many challenges. Flows remain negative, grey listing has dented our reputation and increased frictional costs. The limit changes to Regulation 28 have given investors more choice. But with more choice comes more complexity. The implementation of two-pot is a month away, likely to result in short-term pain for long-term gain. With interest rate cuts on the horizon, the tide is starting to turn. The months ahead will be bumpy as US election fever heats up. But there are real return opportunities for the patient investor. Isn't it time to change how you see investing? Welcome to a new beginning. Welcome to Taking Stock.
Welcome to 91 Taking Stock. Thank you so much for joining us. I feel your renewed positivity even through the screen. Everyone ready for the next South African chapter? Is this a new beginning? Traveling around the country, I haven't felt more optimism than I have since 2012, 2013. Partly due to the post-elections, but there's so much more to it. Lots to cover, so let's get to it. We have an action-packed lineup. I will kick off with the state of the global nation. That'll be followed by a discussion between Nesmira and Rudy Dix. If you don't know his name, Rudy Dix is an unsung hero in South Africa. But officially, his role is the head of Project Management Office in the private office of the South African president. He is responsible for managing many of the key structural reforms aimed at fixing South Africa's economic challenges: energy, ports, rail, water, telecoms, visas, amongst others. Key elements that should improve investment, job creation, and ultimately growth. He is one of the most important people in the office of the presidency and does not have an easy job. That'll be followed by a discussion between Pete Kent, who manages the Diversified Income Fund together with Malcolm and the team, Rihanna Khan, who manages the Equity Fund with Hannes and the team, and then Ian Cunningham, who has had a more outsized allocation to emerging markets in his global multi-asset portfolio. And so we want to hear why hasn't been a conventional view. And finally, Jeremy Gardner for a tour around the world and back home to South Africa. We've said a few times that 2024 is a year to focus on the trend lines and not the headlines, and how that has proven true this year. A fiction well told can often trump the truth. But in investments, that is a recipe for failure. If we believe this headline, that the internet was a passing fad, where would we be today? This is only the biggest political year ever. This is a timeline of what has happened and what is to come, and why some of you look like you've aged 5 years in the last 7 months. India, who is certainly now a country who is driving the emerging world order, has recently received their election results. And we spoke to the Indian High Commissioner at our London conference recently. He reiterated the significant strides made, but lots more to come. You'd have seen the Venezuela election results, where the president and the opposition has claimed victory. And the big one yet to come is the US elections in November. So much has happened. An assassination attempt, last-minute step down by Biden, swings in policy, yet the market has really not moved. Why? Well, the answers are coming. But buckle up, put your hard hats on, because whilst it's going to be raining rocks for a little while longer, and this shows you that in the lead up to the US elections in November, since 1928, markets give you a 25% more rocky ride. But the sun will shine again, and you need to continue to invest new money in the markets, not just what you currently have. Because if you haven't over the last year, this is what you would have missed out. US dollar cash is the 2% line. Global equity is doing 19.4% over 12 months. And you can see that this is driven by US exceptionalism. The Super 7, which has now come off significantly, and Clyde Rousseau, portfolio manager of the Opportunity Fund and Global Franchise, did actually say this at our London conference in June. It's down since that view, despite a rally in the last few days. You can see the 5-year returns in US dollars, north of 10%. And now if you contrast that to SA returns, and this is also in US dollars, just to make sure you can compare it correctly, it shows you the different lens which you're used to. Good 1-year figures, with a lot of that coming post-elections, but 5-year numbers in US dollars not looking as great, partly due to the rand depreciation by 5% to the US dollar over the last 5 years. And so our investment team's view and high conviction on global equities has really paid off. Hopefully, you have trusted your advisor and thanked them for keeping you invested. If you haven't, no better time than after taking stock to call and do it. Now, if you were redeeming from the markets because you were scared of elections and didn't read the 91 articles that showed the higher probability of outsized returns in elections years, you wouldn't have been alone. There's been significant outflows globally in the unit trust space, and you can see that on the left graph by years 2022 and 2023. And where did that globally money go? Well, money market and bank deposits. You can see significant net flows into money market on the right, taking significant amounts of money, going up to $6 trillion US dollars. If you're one of those that let your advisor know, we launched the Global Diversified Income Fund fairly recently. Over the last 8 months, it's now grown to 4 billion rands, and that really allows your money to sweat a lot harder offshore if you decide to park it for a period of time. At 91, globally, we also had a challenged period in terms of flows. We've built a solid platform, as you can see, and thanks to many of you who have been part of that relationship for over 30 years, this helped us build to this stage. You would have seen our financial results. It was a difficult year for net flows. It wasn't what we wanted, but it was what we expected. In rands, our assets under management were still up at a new record 3 trillion rands, which is the size of the entire SA unit trust industry. But our superpower remains our ability to see patterns in South Africa and globally with our unique lens when very few others can. The skill to investing is not about reading what is in the news. It is about estimating what is priced in and what the probabilities are with respect to future outcomes. Manage money for what is to come, not for what has been. A few numbers here on this slide, but simply to say that we have a global business with almost 500 people who sit in our UK office. We have 243 investment professionals, with 2/3 sitting outside of South Africa who don't have a home bias. That's what gives us the edge to keep making money for you. You've seen this slide before. On the top half, the domestic funds, we continue to see significant flows into Diversified Income Fund, and we are one of the very few managers who have also seen good positive net flows into our multi-asset funds, as investors are now looking to take more risk. On the bottom, the offshore funds, global franchise not keeping up with the massive tech rally that we've seen of late, but that is as expected, but protecting whilst we have seen a sharp downturn in the tech performance of late with good flows. Long-term track record still very much intact and outperforming. Global Diversified Income recently launched with significant demand, available now in US dollar as well as sterling. And to show you the value of compounding and taking risk, that is the Opportunity Fund, where many of you have invested, and this is what it has done over the last 20 years. A high conviction, but sleep well fund. Over 12% per annum, net of the highest fee class, with 7% above inflation. What guaranteed fund can beat that? Before I close out, it's with a very heavy heart that I say that this will be my final Taking Stock opening appearance. I have become the face of 91, not because I always have insightful thoughts, but because I always look this good. I have been fortunate enough to be trusted with a significant opportunity by 91 to run our Americas business, including US, Canada, and South America. It is very exciting for me, but I'm really sad leaving many of you, my friends, people who I've helped learn and grow from, and that really is with a heavy heart. So please drop me a line when you come to New York. You'll always need someone to buy you those expensive drinks. Fortunately, at 91, we have significant depth of resources. Siobhan Simpson, who many of you have seen and engaged with before, been at 91 for over 13 years, will step in to run the South African retail funds business. David Stronach will remain head of our platform to complete that advisor picture. You're in very capable hands. I appreciate you. After all, life is only about the people. And so let me leave you with a final thought. I'm more interested in the future than in the past, because the future is where I intend to live. From 91, we would like to say thank you to our advisors and clients for trusting us with your hard-earned savings. We do not take it for granted, and we'll work hard every day to grow your money with us. Until we meet again, wishing you, your colleagues, and your loved ones good health and great investment outcomes.
Today we're joined by Rudy Dix. As Sanjeeth's already indicated, Rudy is head of the Project Management Office in Cyril Ramaphosa's office at the presidency. So Rudy, thank you for joining us.
Thanks, Nasmira, for inviting me along.
And the first question is, what does this mean? What does head of the Project Management Office mean? What do you do?
Yeah, I mean, it's a bit of an odd name to the office, but when the president took when he became the head of state in his first term of office, he quickly realized that there's been a significant lack of capability in execution. That came at the back end, of course, of state capture, the loss of a lot of capable people as a result of that. And he had felt that there was a need in his office where he would have direct line of sight on certain key programs in government. And we initially started off with employment, interventions around employment, around youth employment. We've also did interventions around unblocking, for example, red tape. And that eventually evolved into what we primarily do, which is around the structural reform program, the Operation Vulindlela reform program. So the Project Management Office is really just an execution type office to ensure that we are able to support delivery across government.
And it's about those structural reforms that can actually boost South Africa's growth rate.
Absolutely. So one of our key programs that was announced during COVID in the Economic Reconstruction and Recovery Plan was the structural reform program, where we were able to identify what are the biggest issues that we need to address, and we've identified 5 areas, which is about energy security, improving efficiencies in the port system and rail system, transforming ICT, for example, telecommunications, water reforms, and visa reforms. And we landed on those 5 areas partly because we realized that this would have the biggest impact on growth. And so the structural reform program has become one of our core interventions as part of the PMO.
So energy, transport and logistics, water, telcos, and visas.
Yeah.
Let's start off with energy, because this is something that touches most South Africans' lives. Less so than in the past. I think load shedding was a very present issue for a very long time, major drag on growth, but also major inconvenience.
Absolutely.
We've seen a huge improvement in load shedding in 2024. And initially there was a skepticism that this was driven by the election, that Eskom was burning a whole lot of diesel generators, but it seems to be more fundamental than that.
Absolutely, Nasmira. I mean, I think it's, go back a little bit, in July 2022, the president announced the Energy Action Plan and we formed the National Energy Crisis Committee. And we did a whole set of interventions. 2 in particular was to try and ensure plant performance and improvement in the generation capacity. And the second one largely promoted the structural reforms, which was to open up generation for private sector. So those were 2 fundamental interventions. 2 years later, both of them we can see have had a significant impact. We've seen some significant improvement in the plant performance. We're not out of the woods yet. I think we're on a good wicket, I would say, right? So 127 days of no load shedding. Still a high level of unreliability in the plant performance, but I think with the team that's there, the ability to do the deep-seated maintenance, the ability to be able to get back to the basics is quite important. The more exciting part also is the fact that we've opened up private generation. And that was the reform that we took through around the Electricity Regulatory Act and Schedule 2, and massive investments by retailers, miners, property developers, for example. Today we track 22,500 megawatts of private sector generation projects. So that's been fundamental. We've never seen that before, and that's quite the exciting part. So focus on the plant performance, but at the same time reform the generation market space, so you allow for competition to eventually to come in.
I mean, on that note, 91, together with our landlord Growth Point, became the first company to access power across a municipal grid.
Yeah, absolutely.
To wheel power across the municipal grid, because the city of Cape Town was trying to facilitate this, and we were the test case.
Absolutely, and there's been many projects, or particularly in the mining. Yours, and one of our first, for example, was African Rainbow Minerals, who, of course, had set up a solar group. They had a stake in solar group, and they were the first, if I recall, one of the first projects in 2021, 2022, who had registered the 200 megawatt solar plants out in Northwest, Lichtenburg, by the way. Okay. We went through a process of trying to smooth out permitting and authorizations for them and, get them registered. They were able to achieve financial close, and of course, they announced the commercial operation date. I think they may have come on stream a few months ago or weeks ago, if I'm not mistaken. But that's exciting. So you have this pipeline of private generation capacity. Now, we then decided also to kind of get a sense of, what would this be in terms of investment or impact? And so on the basis of 22,500 megawatts of not potential, but of private sector generation capacity that will come on stream in the next 2 to 3 years, we estimate, based on the models that we've run, that that's about just under 400 billion rand worth of investment. So that's quite a big uptick in the kind of stuff that we do require. That's the kind of fixed capital, investments that we're looking for. So very excited about the reform program. Remember, the end state is really just part of the unbundling process of Eskom, separating transmission from generation, creating a market reform and market conditions through a market code, and allowing for different generators to compete on a generation market where the national transmission company would buy power on that kind of market. That's really the end state. So this is a good start towards moving to a competitive market in generation.
So I want to get to transmission in a second, but if I ask you to split up the causes of the end to load shedding, new generation versus fixing the old. So to date, is it 80% just the maintenance catch-up and 20% new capacity? Is it 50-50? What's your gut feel?
Difficult to say on the percentage points, but it's a combination of different factors, Nasmita. One, of course, is that you've reached a couple of important milestones that we haven't seen for a long time. So, for example, just a few weeks ago, we've reached a maximum generation capacity, or relatively high, which was 35,000 megawatts. The last time we saw that was in 2018. Unplanned load losses or planned outages, for the first time dropped below 10,000 megawatts, and that's also something that we didn't see for 3 years. Then there's a combination of, a decline in demand, and that's partly because of, private generation, but also huge investments in rooftop PV. So you've seen a doubling of rooftop PV, for example, from 2,500 to between 4,500 and 5,000 megawatts. So lower demand, improvement in generation capacity, combination of all of this, then the private generation as it comes in, are going to be important factors. And this has really contributed towards that. But another factor has just been the ability for us to focus on getting additional generation from all over the country, right? So, we issued out standard offer purchases of buying up generation all over. We've looked on the Southern African power pool. We entered into bilateral agreements with Mozambique, for example, and Zambia to purchase the excess capacity that's here. So all of this was important as part of our Energy Action Plan in July 2022. Combination of factors, and I think they've all come into a positive space 2 years later, and we see exactly what happens when you work together and you're able to identify how you want to resolve a problem.
And there's that strength of working together.
Absolutely, absolutely.
If we think about transmission now, everything you've done so far has gotten us to this point. The next step does seem to be around a major investment in transmission.
Quite exciting as generation. The trick about the generation is that you may, see quite a lot of frustrated investors if you're not able to, invest in the grid capacity because there's a lack of grid availability, for example.
Which is a global problem.
Absolutely. Ours is probably, think of ours 20 years behind, right? So we've got to catch up quite quickly. Ours has never been designed to be able to look at the advantages of renewable energy, both wind on the Cape Province or PV and sun on the Northern Cape and other parts of the country. Whereas all our coal generation capacity is in Mpumalanga, that's not the best renewables resources that is there. So you've got to think of the grid very differently. You've got to invest in the Cape Province. If you're looking at wind capacity, for example, you've got to put in high voltage cables, for example. You've got to build those pylons. Similarly, in the Northern Cape, where there's none of that. So we've got to do 14,000 kilometers in 10 years if you want to realize a lot of the capacity, the new generation capacity. 14,000 kilometers, we've got to build it at probably between 1,500, 1,600 kilometers every single year. On average right now, Eskom is doing 100. That's not a good way of doing it.
So we need to go up somewhere between 15 and 16-fold.
Absolutely. And certainly I think one of the interesting changes that we take in, particularly around private sector collaboration and participation, is looking at the private sector participating in the build program. So we're looking at concessioning models, very similar to what we've done on the roads and in SANRAL, where we think of long-term concessioning, where you could do a build, operate, transfer model. And so we're looking at this, and this is quite important. So important signals that we want to send out to the market, where we think that private sector participation in building, operating it over a long period of time, still owned by the state, because I think that's quite important for us to own the backbone and the infrastructure, but that, investment again. So quite excited again. This is a, 10-year plan that I think the private sector can certainly play a role. Of course, we've been involved in the just energy transition and some of the funding stuff, Nasmira. Lots of the interested international partners queuing up to wanting to fund build in the in the transmission space. So lots of opportunities. I think we need to just ensure that we move pretty fast in getting that in the way that we resolve the energy crisis. Or that's another crisis itself.
Agreed. Because, the statistic I always quote is the Northern Cape grid was designed to take a very small amount of power.
Absolutely.
I think it's something like 200 megawatts only into the Northern Cape. Now you have to be able to evacuate a great deal more power out of that amazing solar resource into the industrial heartlands of the country.
Absolutely. And you've got to wheel that electrons, right, as you say, across the different grids, because think of your building and you're building a generator plant, which is PV based out in the Northern Cape. You've got to get it across a grid, right? So think of it as a highway, right? We've got to turn and do this. You've got to get your electrons. So it does take a bit of development and the ability for us to be able to do a whole lot of complex things that are going to be quite critical for you to be able to ensure that what generation capacity you invest in has an ability to be evacuated to an end user, for instance.
So maybe moving on from electricity, because electricity, we see an undoubtedly positive story. Sanjeet's talking about going around the country and people are more positive than they've been since 2012. Part of it is the lights are on. But the other thing that's in your remit, pillar number 2, transport and logistics, is the ports and the railway lines. And that's been more of a challenge. We've seen some improvement from the worst moments of Durban Harbour at the back end of last year. But where are we in terms of our ports and railway lines?
A deep sigh, as you saw, right? Very challenging environment, right? So at least I think lessons learned around how we've dealt with Eskom, how we've dealt with other crises. We've got to do a significant amount of work in trying to ensure, again, one, that you try and improve operational performance of Transnet, both in the rail and in the port space. But at the same time, these are natural, both, if we talk about TNPA or TPT in port, or
TNPA being
Transnet National Port Authority.
And TPT, Transnet Port Terminals.
Authority, which is the operator. TNPA is the owner of the infrastructure.
Yeah.
Similarly, what we're seeing in rail is a separation already. Transnet Infrastructure Manager, like a TNPA, and Transnet Freight Operations, which is the TFROC, right? And so we've got the separation, and that's important. And the important part of, as we do improvements in the operations and get the volumes up, we're going to have to allow for private sector participation on the freight rail network and improve private sector participation on the operations in the port space. So those are critical things that we've got to do. Volumes are up from where they were last year, but we've got a long way to go, right? And as you know, of course, bulk commodities are an important export earner for us, particularly iron ore, manganese, and coal. This is a volume-based game. If we don't get the volumes to the port, from pit to port, as they would say, that has a significant impact on our export earnings and confidence. There is a turnaround plan that the board has adopted, but we've got to do a lot more work in ensuring that we do improve and get those volumes up. Transnet does have a challenge, right? So I think it's important for us to acknowledge that. The lack of maintenance and refurbishment of equipment or infrastructure has not happened. So you'd literally have cranes that are standing at the port. They didn't go through midlife refurbishment. Here at the Port of Cape Town, for example, they have to be replaced. You literally have lines, physical lines breaking or have gone through the wear and tear, and they also need to be replaced. So this is the critical thing that I think is going to be important, that we need to think through the turnaround. The reform program I'm really excited about. So getting private sector operators onto the rail network is exciting. We've not seen that. Transnet had a complete monopoly on that, and so that separation is quite important.
And is there a willingness to get them involved in what were previously viewed as the crown jewels? So the iron ore line, the coal line's been more problematic, but even there, Transnet's always shied away historically from involving the private sector.
Absolutely. It's similar. I think they probably would say the same thing, but this is quite interesting because for the first time we issued a network statement, and the network statement is really just kind of like I describe it as a brochure. So it describes the state of the network. It basically talks about the state of infrastructure. It talks about the role of the infrastructure manager. It calls for proposals, and it sets an access charge, right? So it's been a bit of a quibble about the access charge. I think that Transnet had set an access charge of 19 cents per ton per kilometer, and the market was saying, no, that's ridiculous. We think it should be X, something much lower, of course. But the important part about that is that once you finalize a network statement, what happens next is that there's full open access. And full open access means everything that is on the freight rail network. So of the 13,500 kilometers that Transnet Freight Rail operates on, all the corridors are open, including, as you say, the crown jewels. You may want to think about private sector participation in those volume-based corridors like iron ore and coal very differently. They have fairly limited slots relative to the general freight corridor or some of the other palletized corridors, for example, that are operating. But the point is that what we're looking for is open access. So at least private train operating companies are able to say, well, you know what, since you've opened up the freight rail network, we are going to ask to get access to these slots, and so of course you're able to make big investment decisions. So again, like transmission and generation, once you've done that and it's implemented in this year, TOCs or private train operating companies are able to make investment decisions. So there's a lot of excitement in the freight rail space and the port space about opening up the market for investments in those areas.
And ports in terms of Durban, so Cape Town, we understand the cranes are a problem and they need to be replaced. Durban, there was a massive improvement in the waiting periods between December and the end of January, early February. It's been a bit more mixed since then. But are you net positive on Durban at this point?
Absolutely. Quite positive. I think they've got a real capable management and leadership there. They're quite involved with the private sector and their customers in trying to manage the problem, and I think that's been quite unusual. Not that in other ports of Cape Town, for example, they're also involved with the private sector, but I think that port, given it's the largest container terminal in the whole of Africa, and ranked probably just as one of the worst, as you saw in the port container terminal ranking, right? A lot of interventions that I think is there, but it is the issues of skills. I think that's going to be a critical thing, but also just trying to ensure that we do invest and get the equipment going. Interesting part about what we've done with Durban Container Terminal, particularly Pier 2, is that you may be familiar about the fact that for the first time we had put out a request for proposal for a private equity partner. And so a private equity partner had put in bids, and there were consortiums and many of them. And eventually I think what Transnet landed on was on ICTSI, a Filipino company. Mm-hmm. Now that is in the process of being resolved, and I think there are finalities in ensuring that the strategic equity partnership is signed off. Of course, there's an element of a court case. One of the partners felt very unhappy about it being rewarded. The courts will, of course, resolve that, but there's no interdict to stop the deal from going ahead. Okay. So I think that's quite important. Now, that's a positive spin because of the 4 container terminals, we've never had a private equity partner or private participation in the actual port terminal. So that's quite exciting. And that's the largest container. So, hopefully that would bring us access to global markets, access to equipment, improve port ranking and efficiency.
So in summary on transport, we've passed the worst point on a GDP contribution. The volumes that are coming out of iron ore and coal have improved, and the Durban port is performing much better this year than last year.
Absolutely.
But Transnet as a whole still has a long way to go. Needs a lot more investment. We're going to have to talk about some sort of recapitalization plan, I suspect, as well.
Absolutely, definitely. Although it's difficult, as you can imagine, there's no fiscal space. Unlikely to do something that we've done to Eskom. So we're going to have to think of a combination of different things. But it's the reason why we think private sector participation and being able to get money through that, through access charging and opening up the network is going to be important. So lots of options being considered. Hopefully in this year, we're able to make some announcements to at least ensure that, Transnet has a bit of certainty as to how we deal with the backlog in the infrastructure and some of the capex decisions that unfortunately were not taken. But again, the important part is that open network, right? That access, right? And that's the most important part. Lots of train operators, private sector guys are quite excited, So when that formal announcement is made for third-party access, I think there'll be relatively, long queue of people that are wanting to get access to some of the corridors that Transnet has not run efficiently, or certainly lots of opportunities on getting back from road to rail, palletized goods, sugarcane, for example, timber, automotives, these are important things that should not be on the road, or agricultural products. These should not be on road. This should be on rail. So I think there's a lot of opportunities, again, similarly as I compare to energy, that the private sector could come in and, create a competitive market space in the rail and port space.
I think one of the most positive evolutions that are coming through from the government, but very much highlighted in the discussion we're having today, is the fact that the private sector is viewed as part of the solution and a clear partner. We saw it from the new Minister of Trade, Industry and Competition recently, Parks Tau, talking about the importance of the private sector being a big driver of growth and implementation. And I think if we go back 5 years, that was not the attitude of the government at all. So that is, I don't know if you want to comment on it, but it's an observation from my side that this is a massive change, and we only really starting to see the benefits of that come through now.
You're spot on. I think it's just the obvious realization, it's just like, common sense that growth.
But for a long time, that common sense wasn't there.
I suppose so. I don't want to debate it, but I think the point is that I think we're moving in an important direction where private sector investment and growth, or private sector investment, is quite critical for driving growth. And so the state also has a role in creating an environment for that investment and addressing where there are market deficiencies, But ultimately, I think what we've seen in generation, if you open up that space, you just phenomenally see those things come through. And generally speaking, you in particular, when you see these changes, you generally think these things are going to happen like years later. Yeah. But I think when we took a decision around private generation, we didn't think that it would come through as quickly as in the last 2.5 years. And so we expect the same thing in ports, in rail and in ports, So that's buying rolling stock, it's employing more people.
Well, it's bringing capital and expertise. That's what the private sector can do, is they can bring both the capital and the expertise in an environment where both of these things are in short supply.
Absolutely, and I think this is an exciting environment. So I think this is a really hot investment destination. In a way, you should say that, but I do think, given that where we sit with energy, for example, and transmission, I do think just reaching out to many of the private train operating companies who are interested in open access. They do see this as a absolutely phenomenal, opportunity for them to get access to the rail network, and investing in, buying or building rolling stock here, and that's the critical thing. So you're right. I mean, I think this is important, and I think we've seen some numbers, interesting numbers. Not we that do it, right, in Operation Vulindlela, but others who see the opportunities that we've created by simply doing these reforms, and we should have done many years ago, as you correctly point out. But that we see, potentially significantly higher levels of growth above the existing baseline that's there. So that's exciting, The Bureau of Economic Research at Stellenbosch, for example, had released numbers that they think we could potentially get growth if we continue with the reform program in next year of 2.2%. So that's quite higher than what...
It's been a few years since we got,
absolutely.
Except for the post-COVID bounce, a few years since we got
that's on a low base, right? And then, of course, they do a longer prediction, a very upside prediction over the next 5 years, where they think we potentially could get 3.5 above baseline growth. And so that's really interesting. But it requires for us to be consistent and drive through the reform program. So, we can't do stop-start. We can't have debates around why are we doing this. And, so we've got successes, and it's important for us to ensure that we create an environment for investment and growth. And that's what drives, eventually, the jobs, fixed capital formation, the ability for us to become an important global destination, and just creating confidence in the market again.
And if we put those sort of growth numbers into our debt sustainability models, suddenly the debt outlook looks a whole lot better. Absolutely. Which will then benefit South Africa's borrowing costs, bring down your interest rates, also drive a little bit of a rally in the bond market at some point.
Absolutely.
So it's a very positive scenario that gets sketched, but it requires that implementation. So with that in mind, talk to me about the GNU. Talk to me about this Government of National Unity and the view of the various parties on Operation Vulindlela.
It's been quite an exciting journey, to be honest. I mean, if there's one thing that, for example, unites the GNU is Operation Vulindlela and the structural reform. So I think there's been a positive response from all political parties in that, and so that's quite important. So I think that also helps us to ensure that there's no kind of wobble in the reform program. And many of the ministers that I've engaged with that would have to take responsibility for, the new ministers that have to take responsibility for some of the reform program, have been quite phenomenal and excited in saying, how do you, please come on board. We really want to drive through the reform. Tell us what you need. Can you help and support us? I think that's just been absolutely. So there's one program, it's a structural reform program. So I'm pretty confident that, since my political principal, who was the president and who has given full political support for the reform program, has his ministers behind him also supporting the reform program. I'm quite excited that we're not going to see any wobbles or stop-starts, that we'll continue to see the reform program being implemented by the GNU for the rest of its term. No?
So I'm not going to ask you to comment on this, but I would say from our perspective, it's important for both the ANC and the Democratic Alliance as political parties and the IFP to be seen to be implementing, to see growth improving. And therefore, you as a bureaucrat are in a fortunate area of non-contested space, which we can't say for all departments at this point.
Indeed, and I think that's the nice thing. I mean, let's just look at the minimum program that's there. I think if one looks at the 8 priorities, what's the first priority? Inclusive growth and employment. So that's the top priority, How do we do that? A whole set of other interventions, but the structural reform program becomes foremost, Let's deal with what inhibits us from growing our economy. That's in our control. So a lot of the structural reform program is what we can change to create the kind of investment in those sectors that I referred to, and of course there's significant spin-offs. So I think that's the exciting part, that they put that top in the list. And in the engagements, as I say, with ministers and political principles, is that structural reform is on the lips of everyone, and that makes it quite exciting.
So maybe just in closing, let me ask you about visas.
Yeah.
Because this has been an area that's created a lot of noise over the years, and you seem to be making some positive progress in this area as well.
Exciting stuff, yeah. Of course.
Exciting stuff.
Yeah. Let's be honest, our visa regime has not always been the easiest either to attract skills or to get the kind of, tourists to travel here, particularly in the new growth markets, China, for example, India, or Nigeria, for instance. So what we've done over the 2 or 3 years of Operation Vulindlela is to make a number of recommendations on visa reforms. That was published just a week before elections, and that introduced a whole set of new interventions, for example. One of it was a trusted employer scheme. The trusted employer scheme was basically giving the visa obligations to trusted employers to manage their intra-company visas, particularly multinationals that exist here, Mercedes-Benz, for example, and potentially moving people from one part of the world to another part, and that's quite important. The exciting stuff is a point-based system. So you try and limit the back end and subjective nature of who gets a visa, who doesn't get a visa, right? And of course, it creates a whole set of backlogs. So a point-based system is quite universal. It's in many parts of the world where they try and attract the right kind of skills. And so we're looking at that. So a point-based system is simply, relatively, if you've got, better education, if you're qualified, you have the experience, you score higher points, and that's the kind of people that we require because they have a multiplier effect. One qualified person, let's just say an engineer, can potentially hire 2 or 3 additional artisans, and that could hire a number of unskilled workers as well. So you think about this in a very different dynamic. And so there's lots of reforms that are happening. The minister there is quite excited, and he's already taken some really interesting decisions around, ensuring that he improves the visa reform system. We've also introduced, an e-visa system and visa-free extensions to some countries. The work that we're currently also doing is trying to ensure that we get into the big markets, China, for example, and developing specific sets of visa regimes that can attract Chinese citizens to travel here, or Indian citizens. These are big markets, right? So a lot of exciting stuff. Probably in the next few months or so, you'll see these announcements coming through, and hoping to see, Chinese tourists or Indian tourists coming to South Africa. Tourism, of course, is a big sector for growth, unskilled, labor-intensive, and that's why the focus is quite important for us to be able to ensure that we get those tourists into our country and move up the level of being an attractive destination for tourists globally.
Rudy, thank you so much for your time. I think you've painted a truthful picture of some of the key areas our economy is facing, and fortunately, it's also quite optimistic. It shows a government working with its private sector, trying to use all the skills available and putting together a compendium of reforms in these critical areas that we've talked through today. So I am left much more optimistic on our growth outlook. So thank you very much for your time.
Thanks, Nasmira.
Hello everyone, and welcome to our Markets and Investment panel. As a market practitioner, the last few weeks have been very, very exciting. We've seen some very interesting moves. This year was billed the year of the ballot by an emerging market fixed income piece that we authored at the beginning of the year. And wow, is that really playing out? We've seen the Mexican election surprise. We've seen some surprises from the Indian election. The US election, despite being highly anticipated, is twisting and turning way more than anyone expected. And our own election here in South Africa threw up a few surprises too. We've seen rotations in equities geographically and sectorally. We've seen the yen stabilize and strengthen after a couple of years of depreciation. And more recently, we finally seen the Fed signal that rate cuts are on the way. Very interesting times in markets, and we've got two panelists today that are going to help us navigate these. Sitting next to me, we've got Rahana Khan, who's the portfolio manager on the 91 Equity Fund. And on the screen over there is Ian Cunningham, portfolio manager of the Global Strategic Managed Fund. That is not an avatar. Ian is sitting in London, beaming in to join us here today. So a few things to cover. Let's start with South Africa first. We've just had a fantastic panel with Rudy Dixon, NAS. Everyone quite optimistic on South Africa. So let's start there. Rahana, you and your team have had a fantastic call on South African equities with the election. What's going on in South Africa? How are you feeling about it after this recent run?
Thanks, Pete. I think we're still in the early innings of the opportunity with regards to South Africa, we believe. I think what you can, at the end of quarter one, when you looked at global markets, including South Africa, South African markets were actually down in rands, or even more so in dollars, versus global markets that had rallied quite nicely and given you really good returns. So we've had a rally post the GNU, but like I mentioned, it's early innings for us because the opportunity is quite large. If you unpack it into two areas, positioning and flows,
yes.
Foreigners have been net outflows from the South African market for many years. And post the GNU, you're starting to see that abate. So they're not coming in droves yet, but that's potentially the opportunity over the coming months and years. And the second part is locals themselves. A lot of local asset managers haven't been positioned in a lot of South African Inc. equities within our market. So they started to rotate as well, but it's still early days, right? They're not fully there yet. Then on the other side, from a fundamental perspective, we've had a torrid 2 years in South Africa, massive earnings downgrades across the board to a lot of banks and retail stocks, the load shedding, the port issues, the list goes on and on. And what had happened towards the tail end of last year, that earnings reset for certain companies got so negative that we started to find opportunities towards the end of last year to actually start investing in some of these retailers and banks. And to bring that to life, like the likes of a ShopRite, where load shedding costs were 1.3 billion at the peak in 2023 financial year, that's now dropped to 700 million in their 2024 financial year because the delta in load shedding is improving. The last 6 months only at 250 million. So that trajectory helps the costs to come down and improves profitability for that company. For an apparel retailer, like the likes of a Mr. Price, when the load shedding really hit hard, they were left with too much stock, overstocked. The whole market had to promote inventory, gross margins under pressure, in addition to these load shedding costs. And we're reaching a point now where that's cleaned out of the system. So there's potential for improvement in the gross margins and the operating costs, etc., which improves the profitability of a Mr. Price. And then you top that up with what you mentioned with potential Fed cuts. That's very positive for the SA consumer. Our banks, our retailers, the impairment charges will start to come down in the credit books. But also, the credit cycle can start to turn again, which is, will support growth on an ongoing basis. So very early innings, we believe, in this SA Inc. story with lots of positive tailwinds if you choose the right names in terms of trying to play that recovery in the SA landscape.
That's interesting. I mean, as a bond investor, I think the way that we think about it is, the election has passed. We've got the government of national unity. We've heard about the reform zeal from Rudy Dix. For us, it just feels like the left tail has been eliminated. The market hasn't even started to price in the potential for structural reform and an improvement. So it seems like when you sort of look at the chart of returns year to date, early innings, as you mentioned, we've just sort of eliminated the left tail. We haven't even really woken up to the fact that things could be improving down the line.
Yes, and that comes through. I mean, if you look at the valuations of these banks and retailers at an aggregate level, it looks like a blip on the chart in terms of the move we've seen.
Yes.
But the more impressive part is, the fact that those earnings embedded in those multiples are likely going to be revised upwards, which means those multiples are likely still quite depressed.
Okay, that's fantastic. Now, so you mentioned sort of cyclical names, banks, retailers, those types of things. It wouldn't be South African equities if we didn't talk about resources. Does the same principle of early innings apply when you think about resources in South Africa?
So we're quite optimistic with regards to certain sectors in the resources space. So
Yes.
like the paper side, paper and packaging, we think that's, kind of entering its early cycle, that's kind of troughing. So there's opportunities in the likes of Sappi, Mondi, and Smurfit that we own on the offshore side.
Yep.
But then the other area of resources that we really like is gold. We're very constructive on the gold price.
Okay.
And these gold shares listed in South Africa, like Anglo Gold, Gold Fields, and on the offshore side, we've got Agnico Eagle and Barrick Gold, are leveraged plays on that gold price, we believe. So paper and gold are the two areas of resources that we're quite constructive on at the moment.
Okay, that's great. I mean, we're going to talk a little bit later about your portfolio and how this feeds into your portfolio, but you've touched on gold. And, as a gold bug myself, that's an interesting topic. And I know Ian, sitting over there on the screen, would like to bring him in here. Ian, you've written about gold. You've got some great opinions on gold. What's the investment thesis behind it? Is it just a sort of Fed easing cycle, or is there something else to it?
Yeah, I think there's a few things going on, Pete. I think with regard to some of the structural forces at play, you will have seen, obviously, in recent years in particular, there's been increasing diversification of reserves from a number of central banks around the world. And that's largely been driven by the fact that the US has sort of weaponized the dollar over the last 10 years or so. And on that basis, there's a number of countries that don't want to hold dollars, don't want to hold treasuries, because they may not have access to them when they need them at some point in the future. So typically, when you see interest rates rise from very low levels to very high levels, particularly on a real basis, that's a pretty tough environment for gold. But gold's done okay in the last few years, and that's been largely driven by central bank buying, which has basically absorbed all the selling from investors. And then in theory, as we move into a coordinated easing cycle from the majority of central banks globally, that should be more supportive for gold as we see the opportunity cost of owning gold decline as interest rates decline.
So we're talking about monetary policy here, and that really blows my hair back. We've moved away from my discomfort zone of equities. We're now talking monetary policy. So I need to be careful of not chewing up the entire session on this one. But Ian, we've spoken about Fed monetary policy. We've had a recent meeting where they signaled rate cuts are coming after, it's been anticipated for much of the year. I know you and I talk a lot about monetary policy and where we are in the cycle. What does this mean for your portfolio? Is it a tailwind for all assets? Do we need to worry about perhaps the economic growth signal that's suggesting? How do you think about that in relation to your portfolio and the many places that you can go?
Yeah, I think there's numerous implications as we all know. I mean, if we see central banks start to lower interest rates, then it's going to affect all aspects of financial markets. So I think if we think about equities, for example, across the equity sphere, we've effectively had, if you look at the US, we've had almost a two-speed economy. So you've had areas that are benefiting from industrial policies, mega cap tech, AI-related trends. And then you've had other areas which are sort of have somewhat higher leverage, have been more tied in towards domestic growth, i.e. consumer-related growth, and they've been really struggling. So as we see interest rates come lower, you should see a broadening of markets within equities. So less likely that we'll ultimately just continue to see this very narrow market that's been a challenge for many over the last couple of years. I think within a broader portfolio context, bonds become interesting again. So usually when we're seeing decelerating growth and inflation and easing, bonds become a sensible investment again. They also provide diversification within a portfolio. So the last couple of years, bonds have been a real struggle in terms of they've been pretty correlated with equity markets. I think ultimately we will see more diversification and a lower correlation through the next sort of 12 to 18 months for particularly defensive government bonds. So they offer something within a portfolio again, and obviously a good coupon given the high level of yields. And then from a currency perspective, obviously we've seen a strong dollar in recent years, which has presents challenges in many places. Some of that pressure will start to come off, and that will allow financial conditions to ease on a global basis.
Rana, so I heard the word broadening there, and I mentioned rotation in the introduction. As a bond guy here, over the last 2-3 weeks, we've seen massive rotation in equities. You've seen sort of Russell 2000 rallying, the Magnificent Seven coming off, some earnings lately sort of stabilized Magnificent Seven. All of this has resulted in this sort of magic coincidence that at the index level, things haven't really changed. So there's been a whole bunch of stuff happening under the water. Does this broadening of the market that Ian mentions, is that a sort of ominous signal, or is it a healthy signal, do you think, for the equity market?
It's really, I think we believe, a healthy signal for the equity market. Main reason being, I mean, to be concentrated in a few shares, it's difficult to make returns. For us in our equity funds, we are stock pickers, you know, and so the broadening of that market allows a lot of the ideas that we're finding from a bottom-up perspective that haven't gotten the benefit, you know, of those fundamentals improving because of the fact that money's found its way into that niche little pocket. It definitely does help in terms of the, you know, in terms of the health of the market and with regards to returns on a look-forward basis.
So you and I have spoken in our sort of morning calls around AI and the trend in AI. I think everyone recognizes the power of this thing. I mean, we've even got a TV screen over here with Ian, so I can't imagine what AI is going to do to our lives. But, you know, we've spoken about AI. You know, there's potentially been a bubble. You know, history will judge that, I guess. There's some interesting comparisons to 2000 and the tech boom. But I know what, you know, you're interested in and what you're passionate about is the sort of monetization of it, the next step of it. Help us think about that because, you know, this is obviously important in clients' minds, this trend, whether they need to jump on it and how do they think about it. What is the next leg? How do you think about it?
Yeah, so you rightly point out, everybody knows about the initial stages of AI, which is the infrastructure build, the rise of NVIDIA, the semiconductor chips that's been touted. But the next stage is twofold. It's a thing called Edge AI, right? So you've got a bottleneck in the system in terms of the fact that your cell phone and your laptop, you know, doesn't have the power to be able to use a lot of these AI applications and do what it needs to do. So there's a whole world, you know, in terms of wave coming through, in terms of replacement of this electronic equipment that we use on a daily basis. In a market that's growing usually 0 to 1% in terms of units, there's a replacement cycle that's about to come, which can really benefit companies. Like Apple's been struggling to grow units, Samsung Electronics. We own a company called TD SYNNEX, which is like a middleman distributor for these electronic equipment, etc. So that's the one angle in terms of this replacement cycle as you put AI into devices, because the current devices aren't strong enough to actually, or powerful enough to manage it. The next interesting part in terms of the monetization outside of big cap tech, because we know what Microsoft's doing, etc., is an example is London Stock Exchange that we hold in the portfolio. They've got a joint venture with Microsoft in its infancy in terms of what they're doing, but they were going to start to monetize AI. They're creating all these products using AI. So as an investment professional, we are data hungry. They're packaging that data, making it think for us, setting it all up nicely. So when you walk into a meeting, you've got everything at your fingertips. And these products are going to help London Stock Exchange in terms of being able to monetize that AI through better revenues and products for their clients down the line, which other companies don't have. So they're a bit at the forefront in terms of taking that data and you know, using it in a way to monetize it for investment professionals. And that partnership with Microsoft is interesting because it takes them outside of just the fear of us financial professionals. It can broaden their market to a larger audience in terms of being able to sell product down the line. So it's quite an exciting thing in terms of the next stage of AI. Everybody's quite fixated on the semiconductors and the infrastructure piece, but they are, you know, this is an evolution and it'll keep rolling in terms of the way it's going to impact our lives in a positive and negative way. And so we're trying to build up the dry powder list of names where we believe will benefit from that next stage of the AI journey.
So I'm going to come back to you in a second because, you know, I'm immediately thinking around trade policy and US election. And, you know, Ian spoke about the weaponization of the dollar. It does feel like technology is getting weaponized as well. So I'm going to come back to you because I actually want to bring Ian in here. You know, trade policy, US election, how technology is going to be dealt with. You know, we've already seen some policy ramifications out of the US and what it's done to China. Ian, why don't you tell us a little bit about how you're thinking about the US election, you know, beyond the coin flip of who actually wins, you know, whether you get a red sweep, whether you get, you know, a split Congress and Senate. How are you thinking about that in relation to trade policy? Because I'm going to then throw it back to Rahana and say, like, tell me about the next level of AI when there's kind of weaponization of technology and there's potential trade barriers too. So give us a little bit of a snippet on how you think about the election and what that means for trade policy globally.
Sure. So I think, I mean, the underlying trends. So I think there's certainly bipartisan agreement within the US is obviously the geostrategic rivalry and the risks that China represents for the US from an economic perspective on a forward-looking basis. So I think you can pretty firmly say that there is a technological arms race at play. You have China, which is trying to move up the value chain, which is ultimately going to be competing with many other nations around the world. So effectively outcompeting, as we're seeing in parts of Europe in relation to autos, for example. So China is building a massive semiconductor supply chain. You're seeing the same in the US, where basically the US does not want to be reliant on over 90% of its high-end chips coming out of Taiwan. So there's something like 30 fabs under construction or having been signed off to be constructed in the future within the US. So that's a massive amount of investment that's taking place. And the dynamics associated with these is last cycle we had no capex really within the developed world. This next cycle there's going to be this huge investment taking place because there's economic rivalry and competition at play. So these underlying forces are driving lots of investment, and then on top of that we have some of the policies that are then trying to influence things over the top. So obviously we're all well aware now of the various and increasing, I guess, technological restrictions that the US is placing on exports to China. That will likely continue. So if we see a Democrat victory, if Kamala Harris wins, we'll probably see more of the same in terms of incremental policy targeting those aspects to try and keep China away from the leading edge with regard to commercial and particularly military use of high-end semis and technology, particularly AI. If we get a Republican and a Trump administration coming in, that's going to be potentially a few more fireworks with regard to some of the policies that they're talking about with regard to tariffs and the like. So I think the underlying trends are going to be the same, but potentially who wins, we could see a quite meaningful differentiation in terms of the extent of policy and the impact that will have.
I mean, you raise a great point there. You know, when I go around the globe and chat to our clients about emerging market fixed income, there is definitely an emerging market perception problem. And I think some of it harks back to what you're saying. There's a rewiring of the global order. There's a rewiring of supply chains. China's role in the global economy is going to change. And I think what people underestimate is, I mean, you've written about it extensively, Ian, with the Investment Institute, is what replaces it is actually quite interesting and presents opportunities. So yes, it's going to change, and yes, there's going to be capex, but you know, that's not necessarily bad. There's a ton of opportunities there, especially for commodity producers, especially for nominal growth. That has fantastic investment implications. So Rahana, back to you. On your sort of monetization next leg of AI, you know, the potential political ramifications that Ian mentions, do you think the stories that you're talking about are resilient to that? It's a bottom-up story and they'll just sort of power through these types of things, or is this something you need to factor in your stock selection too?
No, it's something we need to consider. I guess the difficulty is actually determining who wins and how the policy unfolds. So we are expecting a lot of volatility going into this election. What are we trying to position for it? No, but we are, in terms of the underlying stock selection and the stocks that we hold, trying to understand the robustness of the glide path that these businesses have and the ability to actually continue on that journey, yes.
Yeah. Okay. I mean, it's a great point. You know, we had this exact debate last week in the emerging market fixed income team. You know, we've been getting quite bullish bonds for the same reason that Ian mentioned early. And the election risk obviously hangs around and there's potentially fiscal ramifications. But, you know, the conclusion was you could miss out on the bond rally while you wait for the election risk to manifest. Like asset markets, as we showed in those beginning slides, have been having a fantastic time despite the volatility, despite what's been going on. You don't want to miss those opportunities waiting for these risks to manifest, basically.
Yeah, and that's kind of the, you know, our cunning plan, we call it, in terms of having this, you know, dry powder to be able to invest in certain companies. So we've got a list of companies that we're interested in.
Yes.
The sentiment's going to shift around over the next quarter, there's no doubt, but that creates the opportunities, we think, in the months and years ahead.
Fantastic. Ian, I'm going to touch on China quickly. I mean, we've alluded to China in terms of trade policy, the arms race. You know, Chinese growth has been disappointing the last few years. You know, the housing market there, you know, there's been something that resembles a policy error with how tight they made the policy around housing. How much of the growth disappointment in China would you say is down to sort of domestic policy, monetary policy, housing policy, and how much would you say is due to the fact that there's this technology battle that's going on, and it's the start of that? How would you sort of decompose the disappointment in Chinese growth the last couple of years?
I think, when you break it down, Pete, I think ultimately the key elements associated with the disappointment in Chinese growth is the real estate market. So obviously the real estate market has been a big driver of growth and certainly investment, fixed asset investment across the last couple of decades. And when you get a downturn in real estate, as we know from what we saw in sort of the late 2000s in the developed world, it weighs on the consumer for a decent period of time. So the consumer sort of is more apprehensive in terms of spending and ultimately wants to increase savings. So I think those are sort of the key elements associated with what's weighing on growth. Obviously, China is effectively describing what they're going through as accepting short-term pain for longer-term gains. So they are pushing aggressively to move up the value chain. So historically, when Chinese authorities would have stimulated, that would have tended to impact, say, the iron ore price and commodity prices. Now, when China's stimulating, it's showing up in the top and bottom lines of semiconductor equipment companies because they are hoovering up all the technology they can get their hands on to build out, as you say, things like the semi industry, green energy, because they want to be more self-sufficient and they don't want to be sort of held at the whims of sort of political decisions elsewhere around the world. So there's a key rebalancing that's taking place under the surface away from the old and towards what they're calling the new industry, which they believe will be far more productive growth on a forward-looking basis. And I think ultimately the policymakers there are willing to accept some pain for longer-term gain, and ultimately they can do that because they have much longer political cycles.
Yeah, it's a great point, and I think as an emerging market fixed income investor, one of our biggest reliefs, if you sort of said to me, this is the Chinese growth picture of the last 3-4 years, that normally under the sort of old would have been quite catastrophic for emerging market growth, but emerging market growth in general outside of China has actually been quite resilient. So you can kind of see that in the macro data. You can see the fact that it's a different type of Chinese slowdown in the past, and the sort of beta to the rest of emerging markets has been less. So let's get to my favorite part. Let's get to the put your money where your mouth is. Let's talk about the portfolios. So Ian, we've got your portfolio here with the wagon wheel of asset allocation and where we're going. So how do we sort of balance the situation? As you've mentioned, you've got easing cycles coming now. You do have some political risk and some volatility. There's some interesting opportunities in China. There's some interesting opportunities in resources. How do you bring this all together into your portfolio? Take us through it.
Yeah, so I think when we look at things at the moment, I guess our sort of central scenarios are across the developed world. We're probably going to see somewhat more of a soft landing in the US. That's sort of the higher probability. I mean, I think we have to recognise that there is still an elevated risk that growth does slow down on a more pronounced basis, and so there are some risks there. And there's obviously much of the volatility causing events that we've just spoken about as well. So within equities, we do see a lot of opportunities. So the two main themes as we move forward are going to be an enhanced capex cycle across much of the world, which is going to drive everything from resource businesses. So we own companies like Antofagasta, Rio Tinto, Steel Dynamics in the US. It's also going to influence things like consultants who specialize in infrastructure investing, for example. So we own a couple of businesses in the US that are linked into those dynamics. We still see some pretty interesting opportunities in China. So often, I think there's a famous saying that says, the one sale in the world that no one wants to go to is in financial markets, and there's definitely a sale on in parts of Asia at the moment. So we can find some pretty impressive businesses focused largely domestically within China, but also competing internationally. So particularly in the appliance and robotics sectors, as well as medical technology. for example. And then across the rest of the world, we're seeing a lot of more idiosyncratic opportunities that haven't been caught up in this whole sort of AI race that actually trade on pretty attractive valuations for decent growth. And then you can see the fixed income component of the portfolio remains pretty defensively positioned. So we are wholly exposed to defensive assets in fixed income as of today. As I say, we believe they're diversifying. They're ultimately going to offer decent risk-adjusted returns on a forward-looking basis as we move into this easing cycle, whilst potentially providing amplified returns if we do see a downside scenario evolve. And it also gives us some dry powder to put to work should opportunities turn up elsewhere. And then within currencies, I think that the main thing we're seeing that's interesting within currencies is we do still remain marginally long of dollars versus Asian currencies, again, for diversification. We think the Chinese still need to ease a lot more. There's some compelling opportunities within emerging market currencies. So somewhere like Turkey, for example, they've moved from extremely unorthodox policy towards far more orthodox policy, a lot of value in the currency and big interest rates on offer, close to 45% in the currency. And so I think as we look forward, sort of a balanced approach with dry powder to put to work into any volatility.
Thanks, Ian. That makes a lot of sense. Hopefully the global easing cycles I've mentioned, will be a tailwind for all assets. Rahana, I know you've got the ability to go offshore. When I come in morning calls looking for sort of global stock signals, etc., your breadth of knowledge is fantastic. You kind of know global stocks but you've chosen to spend quite a lot of your budget in South Africa for the reasons that we spoke about. Integration really important. How are you thinking about your portfolio? How are you balancing these opportunities in South Africa with what you see globally? Why don't you sort of finish us off with your portfolio thoughts?
Thanks, Pete. Yeah, so we brought a lot of money from offshore back into SA just prior to the election, having spoken about the reasons before. And within that, 70% of our portfolio is on the South African listed market, but a chunk of that's actually sitting in SA Inc. names. So our banks, retailers I've spoken about, some insurance companies, because of the fact that we believe that the earnings expectations for a lot of those businesses are being underestimated and the valuations are extremely reasonable. So we're using a lot of our SA budget in terms of, deploying it into those type of opportunities. But as mentioned, South African market has that resources space. I mentioned paper and gold. But the other area is, as Ian alluded to, China is still spending money. They're just spending money differently. So it's not the property iron ore angle. So we like the base metals, so copper, aluminium. So the likes of a Glencore or a South 32 in the portfolio in terms of trying to angle to the extent of where China is actually spending money now outside of the property space. And then you've got the SA-listed market with British American Tobacco, Anheuser-Busch, and all those things, which are companies that happen to be listed here. So that's where we use our budget offshore, because we believe we can find better opportunities offshore for those, whether we enhance existing holdings, like the paper argument, where we hold paper in South Africa and offshore stocks, or like British American Tobacco, we believe Philip Morris is a far superior company. It's way down the line in terms of its smoke-free business, in terms of monetizing that and growing that. It's at 40% of sales at the moment, and they're targeting for that to be 2/3 of their business. So they're way ahead of British American Tobacco in terms of that growth journey, and it's coming through the earnings numbers, through top line and margin. The other opportunities, we spoke about the AI monetization piece in terms of some of the names and excitement around those type of names in the portfolio. But there's also, this increase in energy usage because of AI, because of all this CapEx spend, etc. And so utility names like Nextera and Ibadola form a really core part of the portfolio. These are quite defensive businesses that can, manage through the cycle in terms of the cyclicality, because they've got firm contracts in place, but also nice growth profiles because of the fact that there's a lot of energy intensity in terms of the pickup in the coming months and years as well. So in terms of the portfolio at an aggregate level, we're now sitting at 70%, as mentioned, in SA, and you'll see us, kind of continuing to hold the line on that, and the broadening of that market offshore does give us opportunities to kind of rotate out of some of our Magnificent Seven holdings into some of those other ideas as the earnings impulse starts to improve.
Thanks, Rahana. Yeah, it's always fantastic when a high conviction view on the government of national unity, South African cheapness plays out for our clients and our clients' benefit. So well done on that. Thanks everyone for joining us today. We've heard that easing is finally here. That should potentially provide a tailwind to all assets. It's almost the inverse of 2022 when inflation provided a headwind to most assets. So hopefully that easing will help us through the year. There's obviously some risks out there, election risks, top of the list, but if you sort of hang around and wait for those, you probably miss the opportunity. You've got some pros here who are going to be able to help us navigate those. And then I think the final point is, we can really end on a piece of optimism for South Africa. It does seem, based on the panels that we've heard on Rudy, when we listened to Rahana as well, there is cause for optimism in South Africa, which is not something we've been able to say for a while. Thanks for joining us, and good luck.
Welcome, and thank you very much for staying on for my portion of today's presentations. At the beginning of the year, when I spoke to you, my presentation was entitled, Could the Tide Be Turning? Okay, and I'm very pleased to be able to stand here today and say that indeed the tide has turned significantly on multiple levels, but particularly in South Africa. And what a difference a year makes. Because this time last year, South Africans were depressed. In fact, I would go so far as to say that I think as a country, we bottomed back in May last year. But I'm going to come to all of that. I'm going to take you back there to remind you of how we felt then, just so you can see how much progress has been made. But we're going to touch on a lot of different things today. We're going to look at all our big trading partners, America, Europe, Britain, China, see how they're getting on, because if they're struggling, we're going to struggle too. And then we're going to have a long, hard look at South Africa and see where we're going. So we've got a lot to get through, but first of all, let's kick off with the video, and then we'll go into the presentation.
Recently released labour force figures have increased hopes for an interest rate cut in the second half of 2024.
The Federal Reserve announced that it will keep interest rates at current levels of 5.3%, which is a 23-year high.
Decided to lower the three key ECB interest rates by 25 basis points.
The International Monetary Fund says the world could see significant swings in economic policy depending on the outcome of elections this year.
It looks set for a shift to the right. If projections hold, she will likely serve a second term as Commission President.
A stunning upset in France. Supporters cheered for the leftist party leader after his party surged to big victories in snap elections yesterday.
Our work is urgent, and we begin it today.
Whether we keep our republic is now in your hands.
So hear me when I say, I know Donald Trump's type.
The people of South Africa went to the polls to decide the future of our country, set aside their political differences and come together.
ANC failed us. The ANC left me behind.
You must be part of history. You must make sure that you are one of the people.
It cannot be that 30 years into our democracy, there are still children who are dying in prickly trees.
We have got more than 12,000 accused persons that are currently civil.
Right, let's look at the world first. The good news is the global economy is finally heading in the right direction. Why? Because global inflation is set to decline in the second half of this year. It was meant to decline in the first half of this year. It didn't. It got stuck. It went sideways, but that decline is set to continue in the second half. As a result, global interest rates didn't come down, which means it's hurting growth globally, and that's why you're all still sitting at record high interest rates. But that is good for rate cuts. Once it starts hurting growth, and the good news is that growth has now become the concern to central bankers more than inflation, which means that we should, in the second half of this year, start seeing rate cuts coming through. As Sanjeev mentioned earlier, there's $6 trillion sitting in money market funds at the moment, enjoying high interest rates that will start feeding into other investment opportunities once those interest rates start coming down. So let's start with the Americans. Finally, on the way down. They've been at 23-year highs for over a year. It's enough. Now it's time to come down. First cut will be in September. That'll lead to a softer dollar, probably 2, maximum 3 this year, and then more to come next year. Softer dollar. The good news about that is then investors will start to risk up their portfolios. We manage money for the biggest pension funds around the world, the biggest sovereign funds. Already we're starting to get phone calls from them saying they want to speak to us about investing in emerging markets. So that'll be good for emerging markets, good for South Africa. Growth in America strong, 2.8% in the second quarter, double what it was in the first quarter at 1.4%. And if there's one stock that is indicative of the strength of the US consumer, and the US consumer is 70% of GDP growth. If there's one stock that epitomizes whether they're strong or not, it has to be Amazon. And do you know that Jeff Bezos, founder of Amazon, is now worth over $200 billion, and that his wealth went up by $85 billion just last year? So I think it's safe to say the US consumer is strong, and if you're wondering, the yacht costs $500 million. So when I say that investors are going to start looking to emerging markets, this is basically the crew that they look at. And we used to be a preferred emerging market, which is not difficult in this particular universe. But then for a while now, because of our own misfortunes and our own doing, we have been sidelined by foreign investors. There's currently, according to Investec, sovereign wealth funds and central banks focusing that oversee $22 trillion in assets starting to turn bullish on emerging markets. That is very exciting for us. And hopefully, this time, we're going to get our share. And I say hopefully because, as I say, for the last 5 to 10 years, because we've had almost a decade with no growth in this country, foreign investors have been staying away from our shores. Okay, so the American consumer is strong, their growth is strong, they're going to start bringing down interest rates in September. That's all good news. Let's turn to their politics. Their politics is going to be a lot louder and a lot nastier and a lot noisier. So I went back to my presentations to see just what I'd said about how Trump was getting on the first time he was president. This was after year one. That's what the Germans had to say. And the thing is, he was on such a roll up until about 2 weeks ago. I mean, he really had it in the bag. It was his race to lose. And he was getting quite arrogant and nasty about it.
Take over a country during my term. Russia took over not because I got along with Vladimir Putin very well. I said, Vladimir, don't do it. You know, you and I are friends. Don't take over any countries because, you know, Moscow will be hit very hard. I told him things. He probably didn't believe it, but you know what? He believed it 10%. And President Xi believed it when I talked about Beijing. He probably said, I don't believe him, but there's a 10% chance we're not going to do anything. It's true. It's true. You have no idea. These conversations I wish they could have been recorded, actually. People would think a lot of me. But with Bush, they invaded Georgia, right? With Obama, they took Crimea. With Biden, they're trying to take everything. And he won't even know they took it.
As you can see, getting nasty. He had Biden up against the ropes, but now the race is very much back on. Harris still needs the official nomination. She'll get that at the Democratic Convention, 19 to 22 August. And suddenly, it's backfired on Trump. He's now the old man in the room. Harris has 15 weeks, roughly, to persuade voters, particularly in the swing states, that she is what they're looking for, but expected to get even more aggressive, more divisive, and more noisy. Also interesting, this is the first time there hasn't been a Biden, a Bush, or a Clinton on the ticket since 1976. There you can see this is about a week old, and this is all the key publications in the US, and you can see all of their polls that they've taken, and Harris catching up very quickly. She's in blue in all of those, Trump's in red. So he's still ahead, but only marginally, and I think that is going to get very interesting as we go closer and closer to the elections. Just by the way, that's how her name is pronounced. Okay, so what do we know about Kamala Harris? Well, she was born in 1964 to immigrant parents, Indian and Jamaican heritage. She studied law. She then became the Attorney General of California, and then she entered into politics. She launched a presidential campaign back in 2019, but withdrew before the primaries. And then in 2021, she became the 49th Vice President of the United States. But she has already made history because she's the first black woman to run at the top of a major US party in history. She's popular. These are the donations that she took on the day she announced, in 24 hours, on the day that she announced that she would be running. She took $200 million in a week post-Biden's exit. So what would Trump 2.0 look like? Well, he's going to be pro some things and he's going to be anti other things. He's going to be anti-immigration. So it's going to be harder to get into America. Even just to get a visa, I suspect, is going to become even harder. He's going to be anti-China. He's going to slap tariffs on top of them, anywhere from 30 to 60%, to try and discourage Americans from buying Chinese goods. The only problem is that the Americans are going to have to pay an extra 30, 40% for their television, their refrigerator, their motor vehicle, etc. He's going to be anti-BRICS. That has implications for us. He's going to be anti-funding Ukraine, but I'm going to come to Ukraine just a little later. He's going to be pro-Israel, quite aggressively so. He's pro-crypto. He wants to end the persecution of the crypto industry, he says. He's pro-fossil fuels, he's pro-big oil, and he's anti-climate change. His running mate, J.D. Vance, his life story is the opposite of Trump's. He started poor and pulled himself up. Trump had a privileged upbringing, disdains learning and the military. So two very different individuals. If you want to understand J.D. Vance, if you want to understand what the Republicans are trying to do in terms of making America great again and how Middle America has been hollowed out in terms of losing jobs, watch Hillbilly Elegy. It's on Netflix. It's a movie, not a documentary. The book is written by J.D. Vance, and the movie is about his upbringing. It's quite hard to watch. He's had a tough time, but it does make you understand where they're coming from and what they want to do. So by contrast to Trump, what will President Harris do? She'd be more supportive of Ukraine. She'd be softer on China. There would still be tariffs, but she'd be softer on China than Trump and Biden. Her concern would be more what those tariffs would do to the consumer than actually trying to punish a country. Stronger on ESG, stronger on climate change, hostile to big oil and fossil fuels, pro-Africa, very importantly for us. And under her, AGOA would pretty definitely be safe. On the subject of AGOA, past weeks we've seen Parks Tao in Washington, our new Minister of Trade and Industry there in Washington, defending our case because it's up for renewal. Now, just to put this into perspective, 10% of our exports go to America, okay? That's second to China. Only 2%, 20% of US exports benefit from AGOA. So only 2% of our total exports actually benefit from AGOA. So not the end of the world if we lose it, but we don't want to. We don't want to get a negative mark against us from the Americans, because then the Europeans will notice that as well. So we want to keep it. Parkstar, as I say, has been doing an admirable job, apparently very impressive performance defending us in Washington. There's a group of Republicans wanting to strip us of AGOA. They're not happy with our positioning in terms of Russia, China, Iran, and the Middle East. The bottom line is we're a small country. We need every job that we can get. We can be friends with the West, and we can be friends with the rest. Turning to Europe, there's a recovery underway. It's slow, but it's heading in the right direction. I think this is a theme with a lot of the countries around the world that you're seeing at the moment. Heading in the right direction, the recovery starting to happen. And their inflation almost back to 2%. Housing market is improving. They're borrowing money again, which is good. That's a sign of confidence. They cut already in May. They're going to cut again in September. Accusations of Russian interference in their elections, you're starting to see that coming through with the Americans as well. The Russians can't resist getting involved in other people's elections. What are they worried about? They're worried about a Trump victory in November, because if Trump wins in November, he's going to cut funding to Ukraine, and the Europeans are going to find themselves very exposed, supporting Ukraine almost single-handedly, and exposed to Vladimir Putin. We had a conference in London recently, and we had the benefit of having General Sir Nick Carter speak there. And what he had to say on the Russia-Ukraine conflict was fascinating. Bottom line is, the West has lost interest in this war. Ukraine is running out of time. November is coming, the possibility of a Trump victory. The Ukrainians had a very tough first half because the Republicans were holding back $60 billion in Congress. So they were short of money, short of weapons, and short of troops. The money and the weapons are finally arriving. Iran and North Korea apparently supplying Russia with weapons. Apparently 15,000 Ukrainians leave every month to avoid conscription. The average age of a soldier in Ukraine is 44, which is too old for the average age of your soldiers. Germany apparently going to halve military aid to Ukraine in 2025, and you can't really blame the West for getting bored with this war and losing interest. It's been going on for close on 900 days. Trump will likely cut US funding. He's made that very clear. He says that he'll end this war in a day. And I think he might actually have some luck with it, because Vladimir Putin, he has a very interesting relationship with Vladimir Putin. And I think he may be able to persuade him to come to some sort of a compromise. And there's going to have to be a compromise. Vladimir Putin is not just going to say, okay, I'll withdraw. They're going to have to draw a line and say, okay, Ukraine, you keep what you've got. Russia, you keep what you've got. But I think Trump could actually find some sort of solution here. Bottom line, there's going to have to be a compromise. Hopefully, they can sort it out as soon as possible. In terms of the Middle East, difficult, not much that I can say in this regard. Certainly at this stage, markets not expecting an escalation. You'll know that change quite quickly just by watching the oil price. It'll change quite quickly if Iran and America start getting involved. Obviously, then oil becomes a major inflation risk. Peace initiatives ongoing. I've put a question mark there because of the events of the last week. I'm not sure whether those peace initiatives are still ongoing. Hopefully, no escalation from here. If all of this talk is making you feel nervous, and by the way, it certainly does make people feel nervous who sit in the UK or in Europe, because they're roughly 2 hours away from a very active war that could spread wider coming in their direction. I don't think we feel the same fear of it, but certainly if you are worried about World War III, just Google where are the safe places to be in the event of World War III, and you'll be pleased to know that South Africa ranks in the top 10. Apparently they say we have abundant food and abundant water, so we should be fine. Turning to the UK. UK's certainly got its issues at the moment. They've got debt bigger than the economy, highest level since the 60s. They've got an NHS waiting list 6 months long, and we think we're going to be able to do NHI better, but I'm going to come to that towards the end of the presentation. Their tax burden is at a 70-year high. Growth has stagnated. Prisons are overflowing. They're going to release 5,500 prisoners by September. Imports and exports 50% lower than they would have been had they not done Brexit. So a lot going on, so much so that the UK population decided that they wanted a change. After 14 years of Conservative Party rule, in comes Prime Minister Starmer. Now, what is he going to do? First of all, he's going to improve relationships with Europe, which I think would be a good thing. Second of all, he stopped the Rwanda immigration scheme. Do you know that that was going to cost them over £10 billion, 250 billion rand? He's going to bolster defence because they're all worried about Vladimir Putin and the war spreading. The UK's fourth Prime Minister since 2021. It's quite something. 3 years, 4 prime ministers. He's steady, he's competent. He was their director of public prosecutions. Occasionally his detractors call him boring, but I think in politics boring is good. Sometimes our politics gets a little too exciting, and I think the Americans would probably say the same about theirs at the moment. But the UK heading in the right direction. They've got inflation down to 2% in May. That's down from 11.2% just 2 years ago. They had a surprise lift in June. Apparently hotels picked up a bit in terms of expense. They blame it on Wimbledon and Taylor Swift. But I don't know about you, but I go to London probably twice a year. And every time I go there, it feels as though the hotels have gone up about 50%. So I'm not sure about the 2% inflation with hotels. They're growing less than us. They're going to grow at about 0.7% this year, probably 1.5% next year. So looking better. Business confidence, highest level in 9 years. Rate cut started last week. We should see at least another one before the end of the year. Problem for us is that they're introducing a carbon tax where they're going to tax imports that come from high carbon generating countries like ourselves. The Europeans are doing the same thing. They're also going to tax high carbon generated products. They're starting in 2026. Now, as you know, because of our heavy reliance on coal for our electricity, we fall into the category of high carbon generated products, which is a big problem. So we're complaining to them, saying that this is unfair because it's going to deepen inequality, and we're not wrong to complain. Emerging markets have been the least responsible for where the world finds itself in terms of climate change, and the most are going to struggle the most with the transition out of it. But the UK and Europe are two of our biggest trading partners. 20% of our exports go to Europe, so we need to boost that change to renewables as soon as possible. China's still struggling, as you heard earlier. There was a slight pickup in the beginning of the year, but that's dipped again. No positive signals yet. This is a problem for us. We're a commodity currency. We're a commodity economy. Crucial that commodity demand picks up to make us feel better. In the old days, the adage was, if America sneezes, the rest of the world catches cold. Certainly today, if China sneezes, emerging markets like ourselves catch cold. We need China to pick up. Okay, let's turn to climate risks. This was put together by the World Economic Forum for Davos at the beginning of the year. And they asked 1,500 experts, chief executives, academics across the world what they saw as the biggest risk to the planet over 2 years and over 10 years. Over 2 years, top of the list, misinformation, disinformation. That's because of the elections that are coming up. Number 2, planet. If you look at 10 years, the top 4 all planet. So, as you know, we have been going on about this for a while. Back in 2007, we were sponsoring Lewis Pugh to swim at the North Pole. He was swimming to highlight the dangers of climate change and global warming. We sent him up to the North Pole because he wanted to swim there to show the world that you shouldn't be able to swim at the North Pole. It should all be ice. So he went up and he dived into minus 1.8 degree water. Now, to put that into perspective, if you've ever swum in Cape Town, that on a cold day is 12 to 13 degrees. He was swimming in minus 1.8 degrees, and he tells me there's a big difference between minus 1.8 and 0. So there he goes, only in a swimming costume. But his point was quite right. There you can see these numbers go back to 1880. And you can see there's been a marked change since the 40s, and it's getting worse. Last year, the warmest year on record by quite a substantial margin. And it doesn't end there. A week or two ago, you had the 2 hottest days ever on our planet, 21 and 22 July. What does this mean for you? Very simply, you're going to see more extreme weather, floods, droughts, wildfires. American insurers had their worst year ever last year in terms of insurance because of a pickup in extreme weather. Another interesting fact, global fertility rates are slumping. Here you can see different regions from around the world all heading down. These are births per woman. And you can see that dotted line. When you get below that dotted line, it means your country's population is shrinking. That dotted line is the replacement ratio. 2.1 is the amount of children that need to be had. Otherwise, you've got a problem. So if you look at this, and you need youth coming through, because you need youth to fund the elderly, their pensions, their healthcare, etc. So if you haven't got youth coming through, it's going to be a problem. And there you can see, if you look at that picture of the world, all of the countries in pink, their populations are declining. You'll notice ours isn't. Ours is still increasing. So we've got youth coming through. That is positive. It's known as a demographic dividend. But you've got to make sure that the youth are properly educated and they've got a job. Otherwise, they become disruptive. And that is our challenge. You've got the Australians complaining that they're having a baby recession with the lowest levels of birth since 2006, which they're blaming on inflation and elevated interest rates. This is after apparently a post-COVID baby boom, which I think happened all over the world. Okay, back to South Africa. Where are we now? So this first quote I'm going to show you is by Claire Bissiker in the Financial Mail. And it's about 4 or 5 months old, and I used to put it up before elections. And when I put it up before elections, my audiences would get through the first 2 lines and then they'd stop. And the second 2 lines, they'd look at me and say, no, you're being naively optimistic. So here's the quote. Every day, South Africans wrestle with the question of whether the country is falling apart or whether there's just enough goodwill and reform momentum in government to halt the slide and restore the country to growth and prosperity. So as I say, pre-elections, they would get stuck at the country is falling apart. And when I said to them there might be just enough goodwill to lift the country back, they would look at me and say, there's no chance, you're being naive. And that to me is the difference, because after elections, now when I put up the slide, the audience embraces the last 2 lines. So that is indicative of a level of cautious optimism and hope that has come into our society's dialogue post-elections. What a difference a year makes. This exact slide I presented to you this time last year. Because as I said, I really do believe that South Africa bottomed in May last year, just in terms of us getting to our most depressed stage. So let me take you back there to remind you how you felt, because we're very quick to forget. A year ago, we were going into winter in May. We just had 3 weeks of level 6 load shedding. Okay, so assuming that we're going into winter, therefore, it was going to get worse or stay the same. There was also very real fear circulating on social media that there might be a complete grid collapse. And apparently, if that happened, we would go down for 2 weeks before they'd be able to put it back up again. No banking, no cell phones, nothing. So there was worries about that. There was also political uncertainty. It appeared that President Ramaphosa had lost interest in the job, and we were told that President Mashatile was coming next, possibly even imminently, and people didn't know much about President Mashatile. So that was a problem. Then also our relationship with Russia was worrying. It certainly didn't look neutral. And then finally you saw the Lady R debacle, where we got accused by the Americans of supplying Russia with weapons. Foreigners decided enough is enough, and they dumped our bonds. Inflation spiked, interest rates spiked, and the mood in this country dropped to the lowest level I've seen, certainly in my professional career. Talk of immigration spiked. I think people did immigrate, but we were very, very negative as a society at that time. And I think the bottom line is we actually couldn't carry on like that. It wasn't just load shedding. It was collapsing rail, ports, rampant crime. In fact, most of our state-owned enterprises were collapsing. Billions of rands of precious taxpayer money being spent on bailing out badly managed state-owned enterprises rather than improving the state of the country and looking after the poor. Record unemployment, also no growth. For 10 years, we grew at less than 1%. I'm going to come to that in a moment. So no chance of creating more jobs. Immigration, the cake of taxpayer revenue getting smaller as the amount of taxpayers in this country got less and less. Bottom line, the country was not being run properly. And on top of that, a government becoming increasingly hostile to most of our major trading partners, which is something we can't afford to do. We cannot afford to put our thousands of export-related jobs at risk. And I think this picture sums up why we couldn't carry on like that. Very clearly, it's called wealth inequality, the Gini coefficient. And for too long, we've been one of the highest countries on that list. 10% of the income in this country 10% of the people in this country take 60% of the income. The other 90% going to the other 40%. We need a government who can look after those who can't afford private education, health and security. Because South Africa is a great country to live in if you can afford private education, private health and private security. But if you can't afford those three things, it gets tricky. 30 years into our new democracy, we should be providing in more. And that doesn't mean creating NHI. We can do it already. We've just got to allocate the resources correctly. As Lesetja Kganyaga, our Reserve Bank, our world-class Reserve Bank governor, said recently, we lost a decade. 0.8% growth, I think it is, all the way back to 2012 because of mismanagement of the country. We were behind other emerging markets, not creating new jobs, rampant unemployment. And as he says, until economic growth is addressed, you're not going to create new jobs. You can't keep beating an economy on its knees, trying to get it to spew out jobs. And this shows you what people give up when they lose their job or when times get hard. And it's heartbreaking to see. The top two are lifestyle related, but then others, very depressing. People cancel their medical aid. They cancel their retirement annuities, their education policies. And we didn't need to be there. If we grow the economy, if we're employing more and more people, you don't have to put our people through this. Okay, so I think we all agree we couldn't carry on like we were before. So let's turn to the elections. I've got a couple of comments to make on the elections. So what this shows you is information from the IEC, which Daily Maverick have taken and put into nice pictures for us here. And what it does, it shows us going back all the way to 94, each 5 years, how many of us actually vote. And I'm talking about how many of the people that registered to vote actually turned up on the day. Okay, the people that came are the ones in blue. So what you can see here, this is 1994. You can see back in 94, the Mandela years. We were full of excitement and exuberance. 87% of us actually voted on the day. By 99, we were happy. We were even more excited. 89% of us. From 87 to 89% of us turned out to vote. 2004, that dropped to 77%. By 2019, that had dropped to 66%. And this year, only 59% of registered voters turned up to vote. Because I think South Africans were losing faith in our democracy because nothing ever changed. And then this year, it changed quite substantially. MK, the big surprise, so the DA went up by 1%, IFP up 0.5%, but MK out of nowhere, up to 14.6, 15%. The ANC declined way more than predicted. The ANC is predicted by most political analysts to come in at about 45 to 50%. So to go from 57 to 40% was a substantial decline. EFF down about 1%, Freedom Front down about 1% as well. And there were big shifts at regional levels. This is Gauteng. The light green dots on the left, ANC, blue DA, red EFF, dark green MK. So the ANC lost control in Gauteng. Interesting, DA, despite all those blue dots, not in the coalition. If you turn to KwaZulu-Natal, there you can see all of the dark green dots, MK, taking 45% of the KwaZulu-Natal vote. Interestingly, they are also not in control in KZN, and most importantly, no violence. That was huge. There were a lot of worries pre-elections that you were going to see post-election violence. We've come through that well. And I think one thing that the ANC doesn't get enough credit for, as Alec Russell wrote about in London's Financial Times, he said, at the end of its 6th term, the ANC has bequeathed, if unintentionally, something of great value to South Africa. It oversaw an election in which it crashed from 57 to 40% of the vote and accepted the result. Voters in Zimbabwe, Angola, and other countries living under one-party rule can only look on with envy. And this is big. And as I said, I don't think the ANC get enough credit for that. There were complaints, obviously, from MK. Here you have Zuma's daughter saying, we were so fixated on the ANC of Ramaphosa rigging elections, we didn't think to guard against the DA's potential rigging. The math is not mathing with their number, she says. Gordon Hill Lewis, Mayor of Cape Town, replies and says, maths and your family were never great friends. Accusations all disappeared when the IEC and the courts required proof. And then at some stage, we're going to have a discussion around this. Do we continue to entertain all of these parties that don't even get a single seat? Do we have to keep printing reams and reams of paper on election day, confusing people as they try and look for their party? when these parties don't even get a single seat. Then there was the confusion about Oranje, the white enclave, where one person actually voted for the EFF. Nobody knows who that person was. Twitter, social media surmising who it might have been. Okay, and here we come to the GNU talks. Okay, so this is Zapiro in his brilliance while the talks were going on. So up at the top there, you can see the big five parties all drawn to scale depending on how many votes they got. Okay? Then you get in the middle the next biggest parties, all drawn to scale. So you get the PA, you get Action SA, the Freedom Front, and then at the bottom, Bosa, Rise Mzansi, Musa Memani, Songezo Zibi, down, and then all of the rest of them. Brilliant cartoon. What I'm showing you though is, and I think this is important, when you get annoyed with the GNU, and you are going to get annoyed because they're going to do some things that you don't agree with, whoever you are, just remember that your party is not in control. That is the thing about a coalition, is that no one party is in control. Also a great cartoon by Carlos, and what this illustrates, and I think this is the brilliance of the president, was that he invited everybody to join the coalition. The fact that MK and EFF decided not to couldn't then be blamed on the president. He couldn't be blamed for going in a particular direction, and I think that was very important. So there's our cabinet. We have a new cabinet, and you can see it's got ANC, DA, PSC, Freedom Front, IFP, all in the cabinet. As a result, the cabinet is bloated. They had to fit in extra people. 32 ministers versus 30 last time, 43 versus 36. ANC are 55% of the government of national unity, 70% of the cabinet. 1/3 of the cabinet ministers are non-ANC. That's how they break down, 68, 2 IFP, 1 PSC, Freedom Front, and PA. But I think you're going to see an attitudinal shift, and I think you're already seeing an attitudinal shift. Expect more energy, more accountability, more scrutiny, and a more competitive environment where the ministers actually compete against each other, which is good for our democracy, good for our country. And finally, hopefully, some delivery to the poor. Don't expect a complete policy overhaul. The ANC had some good policies. It was just difficult for the president to implement, often as a result of pushback from within his own party. And I think he might, in certain areas, actually find it easier to implement with the GNU than he did previously. Why will the coalition work? Because that has to be crucial. Stephen Friedman wrote a great article, and he said the coalition should work because it has to. The alternate is too scary to contemplate. If the coalition collapses, the ANC stays in, DA and IFP are out. And that opens the door to the possibility of the EFF-MK coalition. The ANC leadership don't want this. The DA leadership also don't want. They realize they can do more inside than out, as was evidenced in Gauteng. The ANC also understands the importance of happy markets, and that is very, very important. So that is why the president urges everybody to rally behind the GNU. And I think he's right. We need to rally behind this option because it is in the best interests of the country across the board, regardless of where you sit. This is the better alternative. Another reason why it should stay together, as Stephen Crute has pointed out, is that roughly 3/4 of the members of parliament now belong to parties united in their desire to remain in power, to enjoy their new positions and to prove they can work together. And that is a significant percentage of parliament, and I think that'll hopefully ensure it works. But we have to be careful. We mustn't allow it to be disrupted by individual voices. As Justice Malala wrote in the Financial Mail recently, he said this government will collapse if leaders do not avoid social media and megaphones. They must learn to meet, learn to talk to each other. They are fueling uncertainty. Then he asked the question, is this perhaps deliberate? Are there perhaps some that are not happy with the additional scrutiny that comes under the GNU? So can we look forward with optimism? I think the answer very simply is yes. The GNU won't be easy. They are going to fight. They're going to fight over NHI. They're going to fight over cadre deployment. They're going to fight over foreign policy and a multitude of other issues. But local government elections, I mean, they're going to go head to head against each other in 26 and probably for 6 months to a year before. So those It's not going to be easy. The road is going to be bumpy, but it could have gone horribly wrong. ANC could easily just have chosen the easier route, which would have been to reunite the party, MK, EFF, and we would have been in a very different position today. And I think for that, we have to thank the president. He engineered it towards the coalition that we have today. Bizarrely, you also have to thank Zuma. I mean, the ANC fell 17% in elections. He received 14.6, 15%. Essentially all from the ANC. Without MK, the ANC probably would have gotten a majority. We would have had another 4 years of the same. So effectively, Zuma stole the ANC's election. So what is safe as a result of the GNU? Simon Fremantle from Standard Bank wrote an excellent article where he said the following. First of all, democracy is safe. Okay? Had this gone the wrong way, would they have tampered with the IEC? Possibly. The rule of law is safe. The NPA, the Hawks. Press freedom is safe. We have a very high level of press freedom relative to other emerging markets. Be very thankful for that. It keeps the system clean. And I would actually go so far as to say I think you can probably thank the election result on our free press, our excellent journalists, investigative journalists, etc. That is now safe. The cleanup of state-owned enterprises, arrests happening every day, will continue. That would have stopped. The privatization, allowing business in, that would have stopped as well. The Reserve Bank, SARS, the Constitutional Court, all safe. Improved municipal governance, finally, and hopefully improved delivery. Busi Mavusa from Business Leadership South Africa saying, and she's quite right, she says the beauty of the GNU is that policy making has been liberated from Lutuli House. She said to ensure growth, we need to address the visa backlog, ports and rail fixed, and scrap NHI. Just looking at NHI, been much in the news of late. Here's the president just before elections posting that all South Africans, regardless of whether or not they can afford it, should be able to get great healthcare. Now, I don't think anyone's arguing that. I think everybody is in agreement that universal healthcare for all of our people is crucial. But it doesn't mean we need to do NHI. As Wayne Duvenage tweeted, he said, we all know that, Cyril, but it's not because of a lack of NHI that we find ourselves where we are from a healthcare perspective. It's due to government incompetence, etc. The NHI bill signed into law 2 weeks before the election. So where are we on NHI? The problem government faces is that their track record in terms of running state-owned enterprises is not good. We have a new minister, Aaron Motsoaledi, who replaced Joe Pollard. Joe Pollard becomes deputy. Both are very pro-NHI. There are 6 separate legal challenges against NHI, the first coming through a week or 2 ago, going against government. 4 of the 11 GNU members support NHI. So it's no longer a situation where the ANC can make the decision unilaterally. They're going to need 200 to 500 billion from Treasury, which Treasury doesn't have. As a result, apparently senior Treasury officials are anti-NHI. The minister says he's open to discussion, which is good. I think this has still got a long way to go before it can be implemented, certainly not in its current form. But the bottom line is let's rather focus on spending our existing health budget, which is enormous, properly. Apparently, if we spent that efficiently and made sure none of it disappeared, we would have enough money to provide universal health care to all our people without doing NHI. We heard earlier on about visas. I think this cartoon from Rico sums it up nicely. The Irish did not close us down in terms of visas. There's our green mamba because of the rugby. They closed us down because they're clamping down on migration, as is the rest of Europe, as are the Americans going to do as well. Also because they'd seen a spike in South African passport fraud. We need to close that sort of rubbish down as soon as possible. Henley Passport Index came out recently. You can see Singapore has got the strongest passport in the world. They can go to 195 countries without visas. UK 4th, US 7th, China 69, India 87, Afghanistan last. Okay, they can only go to 26 countries without a visa. Where do you think we come in? We come in 55th. Not bad. Not great, but not the worst either. We can improve on that. We can go to 105 countries without visas. Now, I'm not sure those are necessarily the countries that you want to go to, but you certainly can go to them if you wanted to. But changes coming at Home Affairs. As we heard earlier on, they've been working on it for the last year or two, new minister involved. Traditionally, Home Affairs has been hostile, slow, with a massive visa backlog. They're going to make it easier now for people who entered the country legally to get visas. They're also finally coming, as you heard Rudy Dix explaining early on, with a point system for skilled immigration. That will boost skilled immigration, reverse the brain drain, tourism, investment, etc. They want Home Affairs to become an economic enabler rather than a bureaucratic hurdle, and I think they're going to get it right. Just in terms of electricity, I'm not going to touch on electricity much because we heard about it in detail early on, but I thought this quote by Tom Eaton in Business Day was brilliant. He said, "I know all parents think their babies are special, but if you're a South African baby who was born 4 months ago, you are unique because you have lived your entire life in a South Africa where the electricity is always on." And we find ourselves in a situation at the moment, 130 days of no load shedding. And you can certainly see, comparing last year to this year, we have had much, much less load shedding. And winter is only another week or two, couple of weeks, and then it's over. So all looking much, much better, and diesel spend a lot less. And the recovery is happening. People are starting to feel better about life in this country. Old Mutual came with a very good survey, savings investment survey, a couple of weeks ago. What that said was that respondents feeling overwhelming financial stress. In South Africa, only 37%. Look, it's still higher than it needs, much higher than it should be. More than a third of us. 37%, but it's significantly down from the 45% it was last year and the 58% it was in 2020. 68% of us are optimistic about our financial futures. That is great news. That's up from 53% in 2020. Increasingly using financial advisors, that's good news as well. Still less than half of us, but at least heading in the right direction. More than half of us have multiple income streams. So certainly things starting to feel better across the country, and declining interest rates will make a big difference. Here you can see our inflation. Nice graph, and there you can see predicted well within the Reserve Bank's parameters, which means we're going to start in September bringing rates down, 3 to 4 rate cuts in the next 12 months. Then I saw this, which I thought you might find interesting. These are dollar millionaires. And you can see that we still have the majority in Africa, 37,400. Probably that's 20 million plus. The yellow circles, people with more than $100 million. These are taxpayers. We mustn't chase them away. Nelson Mandela tweeted this during elections. These are South Africans voting at the embassy in Berlin. These are South Africans living in Berlin. Now, I don't know who these people are, but I can tell you one thing. The guy on the right there with his green mamba in his costume there, he wants to come back. And maybe if we start doing things properly, if we start running this country properly, if we start getting optimism coming back, investment coming back, etc., maybe we can start reversing the tide of immigration. Good to see tourism back. Tourism is one industry where we can so easily take more people and expand it. Huge job creator, and we don't need to put in any infrastructure. We've got world-class airports, we've got world-class hotels, world-class people, everything. We just need to get them here. Looking at the Olympics hasn't been fascinating watching. Here you can see that our best year was 2012. I think that was Chad Leclos in those days. Hopefully this year we can do better. So let me quickly summarize for you, just because I find, unless you watch politics closely in this country, I don't think a lot of people realize the enormous fork in the road that we reached as a country over the elections, and how different life would have been had those coalition discussions gone in a more populist direction. So let me show you where we would have been if we'd had a populist coalition rather than the current GNU. The rand would have weakened immediately, okay? Probably 21, 22, possibly even more to the dollar. Bond yields would have spiked, foreigners would have dumped our bonds. Debt payments would have rocketed. Debt is already a massive part of our payments each year. Those would have rocketed, possibly even to the point where we wouldn't be able to afford it. The petrol price would have risen. Now, when the petrol price rises, immediately taxi fares go up, food prices go up, hurting the poor the most. Inflation would have risen. We would now be facing interest rate hikes, not interest rate cuts. Investment would collapse. Jobs would be lost. Unemployment would rise. That means less taxpayers, less taxpayer revenue. Government would have to borrow more. Economic collapse. Politically, The privatization of state-owned enterprises would have been reversed. You don't want the private sector being scrutinizing everything going on. State capture cleanup would have been halted. What would have happened to the NPA? The hawks certainly would have been able to continue as they are at the moment, so that would have been reversed. State capture 2.0, which probably would have tied us down as a country much more than before. IEC, possibly captured. Press freedom, gone, etc. Where are we now? We have our GNU. It's business friendly. You've seen foreigners now starting to buy our bonds again. Rand bond yields strengthen, reduces our debt payments. That means we've got more money to spend on looking after the country. Emerging market currencies, including the Rand, will rise. Inflation then falls. We get interest rate cuts. We're looking at 3 or 4 in the next year. Investment plus economic growth. Jobs get created. The amount of taxpayers rises. Crime falls. More taxpayers, more taxpayer revenue. State-owned enterprise cleanup continues. State capture arrests continue. So 2 very different scenarios. So in summary, expect rates to finally decline in the second half of this year. And then you'll get a more positive global backdrop, which helps with our outlook enormously. Expect more energy, more scrutiny, and more delivery. Improved confidence and investment, improved growth and jobs, and just be very thankful. The ball bounced in our favor. And that hasn't happened to us as a country, aside from the rugby, for a very long time. So the road ahead will be bumpy. We mustn't be naive. But it's exciting. There's a new level of optimism in the country, and at least there is a road. So thank you very much. I hope you enjoyed that. Look forward to seeing you all in person sometime soon.